If you think gross margin is the ultimate measure of profitability, you're dead wrong. In fact, your obsession with it could be killing your profits. Today, we're exposing the truth why companies like Apple, Tesla, and Rolex ignore gross margin dogma and dominate their industries. Let's dive in. If you think gross margin is the ultimate measure of profitability, you've been duped. The business world worships at the altar of gross margin, treating it as the holy grail of financial health, while completely ignoring the hidden power of average selling price. Conventional wisdom is wrong, dead wrong, and it's costing companies billions. The truth? Gross margin is a backward-looking, oversimplified metric that fails to capture the real drivers of profit. Meanwhile, ASP, often dismissed as a vanity metric, holds the key to unlocking explosive growth, pricing power, and customer loyalty. It's time to challenge the dogma. Why conventional wisdom fails you. Most executives, investors, and analysts blindly follow gross margin because it's easy. It's a comforting, standardized number that fits neatly into spreadsheets and investor presentations. But simplicity breeds blindness. Gross margin ignores customer perception. Are you competing on price or value? Scalability. Can you raise prices without losing demand? Psychological pricing triggers. Does a higher ASP signal prestige? Meanwhile, companies like Apple, Tesla, and Rolex have built empires by ignoring gross margin dogma and focusing instead on maximizing ASP. The results? Industry-leading profitability, cult-like brand loyalty, and pricing power that defies economic logic. Let's dismantle the myths and reveal the counterintuitive truths about ASP versus gross margin. 1. Gross margin is a commodity trap. ASP is a premium play. Conventional wisdom. Higher gross margins mean healthier profits. Reality. Chasing gross margin leads to race-to-the-bottom pricing, commoditization, and margin erosion. Take the fashion industry. Fast fashion brands like H&M boast high gross margins, 50% plus, yet they struggle with thin net profits and constant discounting. Why? Because they compete on cost, not value. Now look at Brunello Cucinelli, the Italian luxury brand. Their gross margins are lower, 65%, than some fast fashion players, yet their ASP is 10-20x higher. Result? Higher net profits, zero discounting, and unshakable brand equity. The lesson? A high ASP allows you to control the market, while high gross margin often means you're at the market's mercy. 2. ASP drives psychological pricing power. Gross margin doesn't. Conventional wisdom. Customers always choose the cheaper option. Reality. Humans don't buy products, they buy perceptions of value. And nothing shapes perception like price. The Chivas Regal effect. When Chivas Regal raised prices, increasing ASP. With no product changes, sales skyrocketed. Why? Higher prices signaled exclusivity. Tesla's masterstroke. Tesla's ASP is double the industry average, yet demand keeps growing. Why? Because Elon Musk turned EVs into status symbols, not just cars. Gross margin can't measure this. ASP can. The lesson? If you're not leveraging ASP to shape customer psychology, you're leaving money on the table. 3. Gross margin ignores hidden profit levers. ASP exposes them. Conventional wisdom. Cut costs to improve margins. Reality. Revenue innovation beats cost cutting every time. Apple services play. iPhones have high ASPs, but Apple's real profit engine is services, App Store, iCloud. Their ASP isn't just hardware, it's the lifetime value of a locked-in customer. Amazon Prime. By increasing ASP through subscriptions, Amazon turned occasional shoppers into high-value recurring revenue streams. Gross margin analysis would miss this entirely. ASP thinking reveals it. The lesson? If you're only looking at gross margin, you're blind to your most profitable customers. 4. ASP scales exponentially. Gross margin plateaus. Conventional wisdom. Scale production to improve margins. Reality. Scaling ASP is infinitely more profitable than scaling volume. Netflix. Instead of chasing gross margin on DVDs, their original business, they pivoted to streaming subscriptions, raising ASP through recurring revenue. LVMH. They don't sell more handbags. They sell more expensive handbags. Result? 60% plus net margins in some brands. The lesson? Margin expansion has limits. ASP expansion does not. 5. Gross margin is static. ASP is dynamic. Conventional wisdom. Once you set prices, gross margin is fixed. Reality. ASP is a lever you can pull anytime. Dynamic pricing. Uber surges prices in real time, boosting ASP when demand peaks. Versioning. Microsoft sells the same software at 10x the price to enterprises versus consumers. Gross margin can adapt. ASP can. The lesson: if you're not actively managing ASP, you're stuck in yesterday's pricing model. Break free from gross margin dogma. The future belongs to companies that master ASP, not just gross margin. Here's how to start. Audit your pricing strategy. Are you competing on cost or value? Test psychological pricing. Can you increase ASP without changing the product? Measure customer lifetime value. Gross margin is a snapshot. ASP is the movie. Stop obsessing over gross margin. Start dominating with ASP. The most profitable companies in history didn't follow the rules. They rewrote them. Will you? Gross margin is a backward-looking metric. ASP is the future. The most profitable companies in the world don't compete on cost. They dominate with value. So ask yourself, are you stuck in the gross margin trap? Or are you ready to unlock real pricing power? Do you focus on gross margin or ASP? If this video shifted your mindset, smash that like button, subscribe, and let me know in the comments. What's one pricing strategy you'll test next? See you in the next one.